Welcome everyone to the Financial Freedom Through Apartment Investing, a proud affiliate of the GOB Network of Apartment Investors. I am your host, Mark Caesar. Thank you everyone for being here. So I have a good friend of mine, Marcus Johnson of Johnson Capital Planning. Just a brief background on Marcus and his company. Marcus Johnson is an experienced and knowledgeable financial planner from Nashville, Tennessee, who is ready to work with you to enhance you and your family's business or nonprofit financial future. Marcus has a degree in economics and finance from Tennessee State and also holds his Series 7, Series 66 life insurance and health insurance licenses. After 6 years working on Wall Street and with various firms, Marcus made the decision to start his own financial service company, Johnson Capital Planning, LLC. Over the past several years, he has worked with more than 500 clients to help them choose, invest, and manage plans that will offer them the ability to truly prepare for their future. As a financial planner, Marcus's main goal is to help his clients to make well-informed decisions on what types of investments are right for them. In his practice, he also emphasizes the need to adjust investment plans as your goals and needs change. Marcus will listen to your concerns and share information about potential investments, including benefits, risks, tax issues, and he will treat your financial goals with the same care and interest that he devotes to his own. Marcus looks forward to being your trusted advisor and expert resource as you build a secure portfolio of tailored solutions for your specific financial needs. Marcus was awarded 40 Under 40 by Stay on the Go magazine in Nashville, Tennessee, and is a member of the Chairman's Council. Marcus sits on the board for From the Heart nonprofit, where he is passionate about giving back to his community. He has been a top producer in retirement planning since 2017 and continue to find ways to help clients retire comfortably. Marcus is also an accomplished jazz musician and has played in many places with a range of artists from Elle Varner to John Legend. He has an album on iTunes entitled Passion Speaks Louder. Marcus and his wife, Jamaria, enjoy traveling, spending time with family, and also recording their podcast entitled Our House, which can also be found on iTunes. Ladies and gentlemen, Marcus Johnson. Marcus, I hope I did your bio some justice, my friend. I didn't know you were.
Hey, listen, man, I appreciate you for having me. I didn't know you was gonna read the whole thing, but I would have just took a little blurb of it and just said, "Hey, this is Marcus."
Listen, man, 40 under 40. That congratulations to that. I did not know that.
Appreciate it, man.
You're holding back from a brother.
Hey, man, we just trying to continue to push the culture forward. That's it, man.
Awesome. Listen, man, so the floor is yours. Feel free to
Okay, I thought this was gonna be more of a Q&A. If not, I can kind of go into a presentation that I do a lot of times, but I don't know how formal or not formal you guys want to be. But I can kind of share my screen and show some of the things I talk to people about on a regular, if that's the way you guys want to do it.
We are an open forum here. We're a friendly bunch. We don't bite.
Okay.
As you heard, my friend David Monroe doesn't have his kid gloves on, so feel free to.
All right. Well, hold on. Let me see if I can pull this up so I can share my screen then.
Angel said, "Spill it, friend."
There you go. You see?
No worries. Give me 1 second.
Sure thing.
Time's up.
Where'd you say he went? I'm ready to go.
Marcus attended Nashville State. Tennessee State. My apologies. Tennessee State.
Yeah, you gotta
So I can't say go Vols?
My wife went to UT, but not me. I went to Tennessee State.
All right, love those Commodores.
Yo, so it says host disabled participant screen sharing. So you have to allow me to be able to share my screen.
All right, 1 second. You should be good to go now.
Okay. There we go. Everybody good with that?
Oh yeah.
Okay, so
Oh.
let's get right into it again. My name is Marcus Johnson. I'm the founder of Johnson Capital Financial Planning right here in Nashville, Tennessee, where we specialize more so in retirement planning and actually building plans for clients so that they be able to retire comfortably. And I always say, make your dollars work for you. If you got questions, please don't hesitate to ask. If I don't know something, I promise you, I'm not going to be one of those guys come on here and try to act like they know everything. I'll let you know, hey, I have no idea. Right. But there are some area of expertise that I specialize in and that, I kind of stick hold to. But if you got questions, please don't hesitate to stop me, ask me whatever you want. I will say that if you have some real specific questions that's specific to you, it's going to be harder for me to answer without knowing all the background. So let's keep everything general. But other than that, here we go. So what is retirement planning or financial planning? It's the process of determining whether and how an individual can meet life or retirement goals through proper management of resources. And so basically what that means is seeing the bigger picture, right? A lot of times people come into my office and they're asking, hey, I want my money to grow, right? I want to make money. That's not good enough, right? We need to have a clear idea of what we want our money to do. Whether that's I want this money to be for retirement, whether I want this money to be to start a business, whether I want this money to be to invest in real estate, right? So there's so many different things that we want our money to do, and we need to be specific in it versus just saying, hey, I want this money to, I want to make money, right? That's not good enough. So we have to be a little bit more clear in that. So I say this is the circle of wealth, right? I feel that a lot of times people, they try to put the cart before the horse, right? So we try to do things out of order. And so these steps is the way that I tell my clients to do it. And that's number one is you got to have a source of income. If you don't understand what that is, then we need to have another conversation, right? So if you don't understand that you have to make money to come see me, then we have an issue, right? So if you don't have a job, you're not my client, right? Or if you don't have that trust fund that daddy set up for you, then you can't be a client of mine, right? So however you have a source of income, we got to have that. The next thing is I tell people that, we have to have decent and good credit, right? And so generally what happens is if your credit is messed up, it's probably because you have a source of income problem, or you have a problem with the way that you manage your money, which could be a whole nother conversation that we can have with you as well. And so those two things generally, I tell people that we want to have in order. And so, a lot of times when we're buying houses and things of that nature, they want to see your debt to income ratio under 45%. And if you're over 45%, that lets me know off bat that you probably don't have good credit. And so we need to start working, towards getting that to where it needs to be. Luckily at my firm, we do have a credit guy that is on staff. So if anyone has some of those issues, that's something that we can help you with as well. Then I say retirement. One of the main things that, people are starting to neglect is not putting money in the right buckets and not having any liquidity, right? And so that's something that retirement can help you do. And so we'll get into different types of retirement accounts, and there's so many different things and facets that you can use in retirement, and we'll kind of talk about it. And then the last thing I call it opportunity funds, where we talk about real estate, brokerage account, business, et cetera, et cetera. Generally with this new generation, they're skipping the whole circle and they want to go straight down to the last bucket. Hey, they don't have a brokerage account. They barely even have a checking account. They come to me talking about they want to buy a commercial property. Like, that's just not the way we need to have this stuff set up, right? We need to kind of have stuff in order and have a foundation before we start talking about getting into that things. Any questions on that? So my main goal for my clients is to build a personal financial statement for them. And your personal financial statements help you determine what your net worth is. That personal financial statement lists all your assets and liabilities of you. And your net worth is determined by subtracting your liabilities from your assets. And also you want to make sure that that's including the income statement. That is your income minus your expenses. And so generally what I like to see is for us to kind of do this together. And we do that through building what I call a spending plan. And so, a lot of times people call this budget, but I tell people spenders spend money, right? So instead of calling a budget, let's call it a spending plan. And basically what that is a plan, is an estimation of your revenue and expenses over a period of time, and it usually compiled and reevaluated on a periodic basis. And so what we want to do is find out what your average take home and your stationary expenses are. It always baffles me when someone comes in my office and they have a W-2, or at a W-2 an employee, and they look at me crazy when I ask them how much money they make. you know how much money you make. We don't have to go through this gamut about how much money you make every 2 weeks, because every 2 weeks you're getting the same check. Every 14 days, you know what's coming in. But I'll play the game with you, right? So we'll figure out what that is. And generally what happens is I say we want to track that for 3 months, right? I want to see how your spending is on 3 months without you making any changes, right? And so a lot of times what we find is that people will have Apple Music, Spotify, Tidal. You don't need 3 music streaming services. They all pretty much do the same thing. And so those are areas that we can cut back on expenses if you're having a problem with that. And so, generally what I tell people, there's literally only 2 things you can do when it comes to your spending, right? So either you're going to cut back on expenses or you're going to figure out more ways to make money. And so one of my main principles that I also talk to people about as well is that not only do we want to diversify the different types of investments that we have, but we also want to diversify the type of ways that we get money. So the different income streams as well. And so one of the last things I'll say about this is I tell people that we have to pay ourselves first. And so include that into your spending plan, right? So if we're not including paying ourselves, that's going to be an issue. And then not only are we paying ourselves, but we're putting it away from ourselves and protecting ourselves from ourselves. Because generally what happens is people open a savings account and literally it'll just be a double checking account. So instead of, it actually being a savings, anytime your checking account gets low, you'll just move money from one to the other, right? And so it's not a real savings account, right? So we want to make sure that we're putting that money into somewhere where we can actually have it as a real savings, and then also that money is working for us. And so we'll kind of get into that. Be realistic about your plan, right? If you only make a certain amount of money and you're talking about doing things that doesn't align with that, then we need to reevaluate that as well. So that's a spending plan. One of the main principles that I talk to people about is the rule of 72. And so anytime you talk to a money guy and they can't articulate what the rule of 72 is, you probably need to stop having a conversation with them because they don't understand how money works. There's a huge difference between knowing how money works and knowing how to make money, right? So there's plenty of people out here who know how to make money, but it's talking about how it works is completely different. And so the rule of 72 says this: we take the number 72 and we divide it by the interest that we're receiving, right? So let's say that we have a savings account with JP Morgan or, Chase, or it don't really matter, Bank of America, whatever. And it's paying you 1%. In that scenario, if I gave you $1,000 today at 1%, how many years would it take for your money to double? Right. And so the reason why I want to articulate this to you, because it literally shows you how money works. So you take the number 72, you divide it by 1%, which is the interest that you're receiving, and it'll be 72 years for your money to double. Right. So every time I put my money into a savings account and I'm only getting 1% or less, right, then it's going to take my money 72 years to double. But there's a bigger issue with that. Right. So there's inflation. Inflation is our purchasing power, right? Every year we live life, prices around us are getting more expensive by 3%. So on average, and if prices are getting more expensive by 3%, and I'm only receiving 1% of my money, I'm actually trailing at a negative. So anything we do, we need to make sure that we're putting our money somewhere that we can at least get 3% or better. Now, not telling you that 3% is what we want to shoot for, but that's what we need to be. It's 3 areas that you can put your money: taxable, tax deferred, tax free. Now, out of all these different buckets, I'm sure that you guys could figure out which bucket that you want to put your money in most. I mean, it hands down is tax free, right? But most people are putting their money in tax deferred buckets in the taxable side, right? Because that's what we know about, right? Businesses, our brokerage account, real estate, and then from the retirement side, we're looking at traditional IRAs, we're looking at SEPs, 401ks, et cetera. And we'll get to talking about that as well. Tax-free buckets, you got your Roth IRA, you got life insurance, which a lot of people aren't using properly. And then you got muni bonds. These are all ways that you can put money in places and get tax-free income, right? And so any questions on this? Okay, I'll keep going. So let's talk about 401k, because I think that's what I was brought here to talk about. So most people don't realize that when a 401k was first implemented, it was actually a 3-part system. You had 401k, you had pension, and you had Social Security. And so these 3 buckets were where you were supposed to pull money from. And the max amount of money that you could put into a 401k as of 2021 is $19,500. And so, the reality is that most people aren't putting $19,500 into their 401k. And so what happened over time is companies stopped paying pension because it was costing them too much money. So now we only have 2 buckets. And then what's going on with Social Security is that they keep pushing the age back, right? So first it was 65. Now it's 67. By the time I get there, it may be 70, 72, right? But the reality is what's happening is that you have more baby boomers pulling out of Social Security than you have of Gen X and millennials putting in. So that's why the age continues to keep pushing back. So generally what happens is that you're putting your money in your 401k, right? And you're going to be putting that money in. And hopefully if you're at an employer, I get asked all the time, should I participate if they're matching? Absolutely, right? If your employer is going to match you in your 401k, you have to take that. That's free money. You're not going to get that anywhere else, right? And so all the money that's going into your 401k is what we call pre-tax, right? So that means that it's growing tax deferred. And so when you get to retirement age, that's when you'll start pulling money out, and then that's when you pay the taxes. That tax rate is just going to be dependent, right? If you don't have an income anymore, then it'll be different. But if you're still working, say you retire from one job and then you go into another, maybe as a consultant or whatnot, then the tax rate is going to be different. But, that's generally how it works. And so what I talk to people about is figuring out how we're going to replace the pension bucket, right? Because if the only thing we're doing is 401k and then trying to depend on the Social Security, it's probably not going to be enough. So we need to have, multiple ways of putting money away so that once we get to retirement, that we're actually comfortable. Because at the end of the day, all retirement is replacing today's dollars tomorrow. That's the main goal. I don't care what anybody tells you, right? And so, if anybody wants to debate, I'm here for it, right? But the idea is that, everybody talks about retirement as it about assets, right? And of course, we want to have assets, but at the end of the day, retirement is about income, right? And so income is what we really are looking for once we get into retirement. And so, because if all of our money is tied up in our assets and, then we need money, then we have to sell it. So now we don't even have the asset. So, right, the idea is that we want to make sure that we're building up enough wealth inside of our retirement plans that we're able to produce an income so that we don't have to work anymore, right? Work because we want to, not because we have to. So one of the other things that we like to make sure that you can't talk about wealth without protection. So, we want to definitely look at different ways of how to protect yourself from, short-term, insurance, from, DIs, which stands for disability. If you have a partner, maybe looking at some buy-sell agreements. A lot of times people get into partnerships with people and then something happens to that person and then they may have to go into a situation where maybe their partner passes away. And the reality is you probably don't want to be in business with that person's family, right? But if you had a buy-sell agreement in place and an insurance product attached to it that the insurance company would buy their partner out who passed away, and now everybody's good because the family gets money and the business owner is able to have full control of the full business. Outside of that, we talk about long-term products such as universal IULs, which are able to do some great things. You can take an insurance policy and overfund it, and all of the income that you make off of it is going to be tax-free that you can use in retirement to do some cool things with. So, those are some things that you can explore as well. So, main thing is we want to make sure that we're talking to you about is making sure that we want to have some type of protection plan in place with it as well. Now, this is one of the main questions I get asked all the time is how much money do I need to retire? And so basically what it is a quick equation that anybody can do for themselves. And what you want to do is you want to take whatever your desired retirement income is times 2 times 20, and that's going to equal your retirement goal. So let's say that you wanted to produce $100,000 for the rest of your life. Your times it times 2 times 20 will equals $4 million, and that's going to equal how much money you need to have saved up. Now, how do you get to that 4 million? That's what we can talk about, right? What are some areas where I can have my money invested in that we can make sure that we get to that 4 million mark, or what does that look like? And so, I mean, if you only needed 50,000 in retirement a year, then you cut it in half. So I only need 2 million, right? And so depending on how much money you want in retirement, that's basically the formula that you should use to kind of get a good number and a good ballpark. I think this is the last slide for this presentation. But this is where I talk about estate planning. This is really important. A lot of times people start having assets and things of that nature and don't have the documents in place that they need, which is, will and trust, a durable power of attorney. This is a big one, beneficiary designations. A lot of times people don't even have a beneficiary, right? So you have these accounts and things set up, and then something happens to you, and then you don't even have where it's going to go. And so now it's got to go through probate. It's got to go through, and it's basically the idea of estate planning is is simply ensuring that your estate is not destroyed by taxes on the transfer of death. And so basically having these documents in place will kind of help alleviate that. So I think that is the last slide. So I'm ready to talk questions and specifics about, different type of retirement accounts, and we can make it as, as interactive as possible.
All right. Angel asked a question.
Okay.
We know our net worth, but is there a formal PFS for this?
So can you be a little bit more specific?
Angel, take yourself off mute.
Okay, so like we've figured our net worth, but like, is there a formal personal financial statement that kind of goes across the board that is accepted?
Yeah. So generally, I mean, it's going to be, regardless, it's going to be just your assets minus your liabilities. And that's just going to be simply it. And so I have one, like a worksheet that I created for people so that they're able to kind of document it, but it goes a little bit more in depth, because not only is it including your assets and liabilities, but it's also talking about some of your future plans and whatnot, right? So whether it's, hey, I want my kids to go to college and I want to make sure that I can take care of that. I want to do X, Y, and Z. So mine has all of that stuff in there. But generally it's going to be across the board, pretty much the same thing.
Angel, I just sent you a version that I had created for myself that is lender approved. At least I've used it to get my own debt. So
thank you.
Or just emailed it to you. I tried putting it in the chat, but it wouldn't let me.
Angel, what was that? You mentioned something about you said, would you then need to multiply by one? Angel, stop laughing. 1.03 to go ahead, Angel, and square that question away.
So like, if you take the 2 times 20 and then you multiply by 1.03, will that inflation correct it?
I mean, you can use it for inflation, but I'm knowing that if we get to the numbers that I put up, I know that we're going to take that money and invest it into a vehicle that's going to get you 4.5%. So the math works itself out.
And Marcus, following up on that math, is that a generalized multiplication chart? Does that make any difference between, as you mentioned earlier, pre-tax and post-tax accounts? Would you adjust that?
Yeah, so this is a general, right? So of course, if I'm sitting down with a client, we're going to actually put it into my system. Where it's going to account for inflation, it's going to account for pre-tax, it's going to account for, post-tax, because some people have Roth 401ks, and so it's going to account for all of that. But for somebody just to kind of get an estimate of what it could look like, they should use that formula. It's not going to be an exact science, but it kind of gives you a good ballpark of where you want to be.
Understood.
Yep.
Marcus, when you talk to your clients about investing, do you ever talk to them about investing in commercial products?
Commercial products as far as real estate?
Yes.
Yeah. So what I tell people is that I make sure that when we're talking about investing, I say that we want to diversify, right? But I also don't believe that you should have 100% of your capital into any investment, right? So that whether that's real estate, whether that's in stocks, whether that's business, whether that's, whatever, we want to make sure that we're diversifying against different platforms. And so the reason is because, right, so if I got all my money tied up in real estate and then I need cash, it's not liquid, right? I can't sell a portion of a house. I need the whole thing, right? I have to sell the whole thing, and that could take time, right? So, but if I have liquidity in other areas, and i.e. brokerage account, retirement accounts, et cetera, I don't have to go to another route to sell an asset to be able to use the cash for whatever I need. So across different platforms, I just want to make sure that we're investing in all areas. But I tell clients all the time that, yeah, if you don't have that a part of your portfolio, we definitely need to start looking into it, right? So whether that's, buying single home families, whether it's commercial, whatever, we want to make sure that we're doing both across the different platforms.
Okay, good.
Yeah.
So Marcus, do you perform the duties of a broker dealer?
So I am a fiduciary. I still use a broker dealer as well, which is Securities of America. And so my firm uses them as basically a custodian and broker dealer. And so that's who we clear all of our investments through. which actually is Pershing. I'm not sure if you heard of Pershing LLC, but they're a custodian who actually holds the client's assets.
So I do have a question for you, Marcus. So this
Okay.
is in general for, you know, whoever's in social media land right now watching. So the initial reason I brought you in is because I hear a lot about, you know, how to use your retirement accounts, whether it be a SDira, a 401k, to invest in real estate or any other vehicles. Can you, you know, expand on that, not give some knowledge to those who may not know out there that are watching via Facebook?
Yeah, so basically the question is more geared towards the self-directed IRAs. And of course, I knew I was going to get asked that by real estate folk. And so, you know, there's some good pros and there's some cons, right? But I just give people the information. And so the idea is that you're able to open up a self-directed IRA, which is a process in itself. It's not the cheapest thing to do, right? But you're able to do it. And inside of it, you could pretty much hold any type of, well, I'm not gonna say any type because there are what they call prohibited transactions, but there are several different options of things that you can hold inside of it, from, you know, from real estate to commodities to, you know, of course, stocks, bonds, et cetera, et cetera. And the idea is that if I have my real estate, which has to be held into an LLC, so it can't just be in your name. So you have to form some type of LLC and then slide the real estate into the self-directed IRA. I'll say I had a property and then I sell it. Right. And so then I can take those profits, which, you know, would be taxed. I can put it into my self-directed IRA. And now that money is going to grow tax deferred. So basically, I'm just kind of avoiding the taxes that I made have paid up front, but the profits go directly back into the self-directed IRA. And now it's able to grow tax free until whenever I get ready to retire. Some of the cons is that, of course, once that money goes in there, it's supposed to be designed for retirement. So if I take money out beforehand, then I'm going to get penalized on different things like that. One of the other cons is it's not cheap, right? It's not a lot of people who actually set these things up. So you have to find, you know, trusted, you know, groups who actually do it for you. But, you know, one of the main things I see that people love about it is that you have so much more control on the different types of investments that you can hold inside of it. But I just caution people to understand that, you know, this is not a short-term play for self-directed IRAs. It's more so of going to be a long-term situation. So when you get into it, just understand that it's going to be, you know, for a long-term horizon versus it just being about today.
Do you guys mind if I jump in and follow that up with something real quick?
Yep.
Corey, go right ahead.
Yeah, my name is Corey Dayharsh. This is my first time joining the group. I saw Mark's event on Meetup, but the topic really got me. I work with Advanta IRA, and we are a self-directed IRA administrator. So we've been in business for about 20 years. We've got a little over 1.5 billion in assets under management. And basically everything Marcus just covered is true. Self-directed investing is something you'll obviously want to do your own due diligence for. It's a way to diversify part of your retirement income and generate passive income through your retirement. And specific with holding real estate, you really can take in big earnings when you sell properties or just renting out properties for long term. There's no such thing as capital gains tax when the assets held within a retirement account. So whether it's traditional or Roth, it's either growing tax free or tax deferred. I've left my contact info in the chat box, so feel free to reach out if anyone's interested in learning more. I've been with the company for about 5 years now. Most of that time I've been a client account manager, so I've processed thousands of transactions for my clients over those 5 years. I've just recently switched to business development, and that's why I'm on Meetup trying to find groups like this just to talk and network.
Hey, Corey, let's talk. I mean, I get asked questions all the time. I don't do them directly, but I know I'm in Tennessee, so I know it's a couple firms down here that I have been referring to. But like I said, you know, I'm not a subject matter expert in the area. I understand how it works, but you're definitely going to have to go through, you know, a third party who's going to actually set the stuff up for you, because I don't do that.
Sure. Yeah, I am a subject matter in that capacity. I'd already written down your contact info. I was going to reach out to you after the session, but thanks, Marcus. I'll be sure to get in touch.
No problem.
For sure. And I'm in Asheville, North Carolina, by the way. My company's based out of Tampa, Florida, and we have an office in Atlanta. Again, I've been with the company for a few years. My wife and I just packed up and moved to Asheville, and I've just been working here remotely trying to network.
Gotcha.
So close enough to you.
Yep. Yeah, absolutely. The other thing I would add, you know, outside of that for people who are business owners. So if you're, you know, you own your own real estate, development company, or, you're doing things like that, and you kind of have your own thing going on, the types of plans that you want to look towards is probably going to be what we call a SEP IRA. And so that's probably going to be a good route for you as well, because you're able to put, as of 2021, you're able to put up to $58,000 a year into your SEP. And all of that money is going to be tax deductible. So you basically, instead of paying the government, you could be able to pay yourself. And inside of that, you'll be able to hold, stocks, bonds, mutual funds, et cetera. And so that'd be a good fit. Or if you have employees, you might want to look at something what we call a simple IRA, right? And so you're able to contribute up to $13,500 to that. The reason why you would do that is because it's an incentive for your employees. Because if you do a simple IRA, then you have to give a employee match, right? So you can do up to 3%, 6%, whatever it's going to be, and you can contribute to that as well. So there's so many different options that you can use in the retirement space. It just really depends on, what your specific goal is, which is what we talked about at the very, very beginning. Just kind of mapping out what you want your money to do, understanding that, I can't only just do one thing. It's kind of like if you were starting to work out and you went to the gym and only thing you did was arms, right? It's probably not going to be your best bet, right? You want to make sure that you're doing more than one thing. And I tell people all the time that, this isn't a do-it-yourself project, right? Some people come on here and they think they're smarter than the guy who sits here and do this every day, right? And I'm not, accusing anybody on this call of doing that. Of course not, right? But what I will say is that, it takes a team to kind of build these plans out to make sure that you're, putting your money in places that, are going to be beneficial to you down the road.
Awesome. Does anyone else have any questions or any thoughts to what's been shared in regards to Marcus's presentation?
I just want to let her.
Oh,
yep. Nope. Go ahead.
So I'm looking at rolling over my Texas teacher retirement into something self-directed.
Okay.
So that I can invest in real estate. But how, if it makes gains within that, it's tax deferred?
Tax deferred.
So when do I pay those?
So you're going to pay them once you actually get to retirement. So once you start taking your, what they call RMD, which is your required minimum distribution. And so that's when you'll start actually paying the tax. And the tax rate is going to be depending on, if you still have an income at the time, or, and things could change as time goes on. I don't know if Corey wants to talk specifically about how, the self-directed route goes, but for traditional IRAs, that's generally how it goes, is that once you start actually taking the income from it, that's when you'll start at 59.5 or above.
Okay. Yeah, I'm happy to pitch in on that as well. So Andrew, you could open up the self-direct account when you roll over those funds in a traditional or a Roth status. That'd be something I would have to defer you to your own financial planner. In this case, let's consider that to be Marcus, whether it's within your strategy to pay the taxes right now and have that account open as a Roth account and proceed letting it grow completely tax-free, or paying the taxes later on, like you mentioned, whether it be at your RMD age or after you reach age 59.5 and can start making non-penalty based distributions out of that retirement account. But it's really strategizing to do along with your tax preparer or financial planner.
And kind of piggyback on that. And so, I don't know your specific situation, but if all that money is pre-tax, then it should go into a pre-tax account. Now, they are doing some things called safe harbor, where you're able to take the money and convert it into a Roth. And so you kind of take that hit now, and so that later the money grows, basically tax-free, and then you're able to take that money tax-free. But you really need to sit down and do that in conjunction with a tax planner, along with the financial planner, to make sure that it makes sense, because sometimes people take these hits assuming that, the markets are just going to continue to do what they've been doing. And, I'm just not a believer that we're going to continue to see the types of returns that we've been. So it may not make sense, but some people are comfortable saying, hey, I don't care. I want to just go ahead and take the tax penalty now and just pay it. And then everything converts and it comes out tax-free. But it really just depends on your specific situation.
Well, we're going to owe more taxes as time goes.
Yeah, absolutely. Tax rate is going up. I don't care what anybody says, right? So, you know, regardless of who's in office, right? I don't care if you're Republican, Democratic, Independent, Blue, whatever, right? The reality is that taxes are going to go up. And so, you know, I do think that it's flawed system with all most people's, you know, nest egg is in a tax deferred vehicle when we know taxes are going to go up. So being able to diversify across different platforms, which is why I'm a huge believer in IULs, because you're able to dump so much money into it and don't have to worry about any taxes on it. And so, you know, it's just so many different things you can do, but you have to be specific. And I hate giving out, you know, general or specific information without knowing everything up front before I make an educated decision.
Yeah. On IUL, you're talking like infinite banking?
No. So IUL stands for Index Universal Life.
Okay.
Mm-hmm.
Okay.
Corey.
Yes, sir.
In reference to Angel, right? Once she draws on that money, she's going to pay taxes.
When she draws it out of an account, sure, yes.
Okay, so if she was to take that money and put it into, let's say, a commercial deal, and you know, commercial deals usually it could run 3, 5, 7 years, even 10 years.
Sure, that's standard syndication, sure.
Right. So then let's say instead of her taking that money, and because by that time she'd be a little older, how about she just do wait a minute. Will she have to pay taxes on her distributions?
That depends again on if the account at that point in time is traditional or Roth. So if she's paid the taxes and turned the funds in the account into a Roth account, then that entire account is tax-free upon distribution or at any point. If it's still traditional status, she would pay taxes as she's taking it out until the account is in itself fully liquidated, or
at her new earned income rate, which generally when you're in retirement, the way that it's supposed to be designed is you shouldn't have an income anymore. So you should be paying the lowest taxes. Right now, the reality is most people are kind of living a hybrid life now, right? Because people are retiring, but yet they're still doing other things, right? So their taxable income is kind of higher. So that's where the problem is starting to lie. And so, you know, that's some things that you should think about whenever, if you do decide to convert it or whatnot. But I would definitely tell you to, you know, speak with someone in conjunction with, just to make sure that it's going to flow properly. But that also depends on what is the overall goal? What are we trying to accomplish?
Right. So Corey, when she get her distributions, that money has to go back to her IRA, right? Or her self-direct, I mean. It has to go.
So let's talk the self-direct in itself, referring to 401ks, that self-directed IRA, Roth IRA. The income generated by its investments must come directly back into the account, whether it's a syndication, whether it's real estate directly, and you're just talking about the rental income it's generating. If you're a hard money lender, the note payments and the interest on the note come back directly into the retirement account.
Got you.
Precious metal, energy.
Because what I was
all
thinking,
this stuff has to go back inside the account.
Yeah, because what I was thinking, because I was thinking like how could she accept? I know when she get the principal back, she could do a 1031 and roll it right into the next deal. But the dividends, but that distribution on it, it has to go back into that self-direct.
Correct. And even in that case, the 1031 would be part of the retirement asset rolling into the new deal, still as another retirement asset. I'm not specifically well-versed in 1031, but my company does have referral sources that I could point clients to. But at least in the capacity of answering that, what you said is correct.
Okay.
So
yeah,
I have a question then.
I'm just trying to make it where she ain't got to pay no taxes.
now I'm trying to wrap my head around it.
Or minimize. You know?
Yeah. So all earnings in the self-directed have to stay within the self-directed, and it just adds to the total balance that's going to be paid out into retirement.
Correct.
We're good.
So that's why I generally tell my clients that the only con that I've seen is just a lack of liquidity if you're under the age of 59 and a half. But that kind of falls into most retirement vehicles, with the exception of, Roth, you can do some cool things with taking money out before that 59 and a half. But that's getting real specific to your situation. But, again, this is not a short-term play as far as a self-directed IRAs. It's more of a long-term play. So you just have to understand and do your due diligence to make sure that's going to be the right fit. And I know it's really big in the real estate realm right now, because you can hold that hold that stuff inside of it. But I would just tell you, just make sure, and I wouldn't probably put all of my eggs in one basket, which I'm sure he would probably tell you the same thing.
So Angel, the deal, like what Daryl said, and everybody so far has been correct, but with a 1031, the whole LLC would have to go. So you're getting your distributions. It's all going back into your IRA. Come sale, you get your proceeds from sale. You don't have to pay tax on those proceeds. Those proceeds can go back into your IRA and you can continue to enjoy life. If you don't, if the LLC decides that they're going to 1031, your money goes with the LLC to 1031 because they have to 1031 as a group unless they split that 1031 up prior to the sale of that property. In that case, you're probably going to want to just put those proceeds back into your IRA and not fool with it. But if the LLC's exit strategy is to not 1031 and to pay the tax at the end of the investment, then you must put it back into your IRA because you darn sure don't want to take it out and put it in a DST. I don't even think you're capable of doing that or not. These two guys that have to answer that question, but I wouldn't know why you would even want to.
I don't know why you would want to do that.
Right. You're just going to put it right back in your IRA.
Yeah.
Okay. So you alphabet soup me a little bit there, but I trust you.
That's because I'm good at doing that.
All right, guys. So if we don't have any more questions, I will just have a couple of break. I'm sorry, did someone have a question?
Yeah, Mark, one more thing. While everybody was talking, Angel had mentioned a personal financial statement. I had created one a few years back when I first became a syndicator, and I went ahead and uploaded that to GOB for all you that have access. It's now in because I couldn't find a good folder. If you go to library and accounting, it's in there under the accounting folder in library.
Okay. So I will upload it, and whoever needs it, feel free to just drop a message in the chat and I'll with your email address, and I'll forward it over to you. Thank you, David, for sharing. So if we don't have any more questions, I'm sorry.
Nobody have any questions? I've never got on one of these calls and never got any questions about stocks or any of that, but I'm talking to real estate folks. I get it.
Yeah, we like to invest in what we know and understand.
That's the whole point of me. Why you bring me on here and you don't want to talk about stocks? That's what I do.
Listen, if someone has a question on stocks, feel free to shoot. Open book.
What's this GameStop thing?
What'd you say?
Yeah. What's this GameStop thing? Should I buy or not?
It depends on what type of position you're gonna buy. I don't know how long it's gonna be able to sustain as a long position, right? You could probably get in on some, on an option play, maybe short it by a put for January of next year, and make sure that this is not advice for. I have to say that this past performance does not dictate future returns, and you should consult with your financial professional before making any, stock decisions, right? So now I got that on there and it's recorded. But some things that you can look at is, maybe looking at a put for down the road, right? Because it's not going to be able to sustain being at this price. I mean, you look at the income statements, you can look at pretty much anything. There's not any real substance there to price up. So it's going to start to continue with the drop. So I probably wouldn't go in with a long position, but if you can figure out a way how to get in with a short-term play with a put option or something of that nature, I probably would make that type of play.
Hey, Marcus.
Yep.
Hi, my name is Greg. Thank you for the information. I'm real grateful for that. I got a couple questions. Question one: the webinar tomorrow, is that free and open to anyone?
Can you hear me? I don't think that's Marcus's webinar. I think that
Oh,
was
okay. That's. I'm
David
sorry.
and
Webinar tomorrow.
Well,
Maximize your retirement account.
yeah, I had posted that.
Okay.
That's just a webinar that I'm hosting with a colleague of mine. I put that up when Marcus was talking about contribution limits because the topic tomorrow specifically is maximizing your contribution limits. It is free and open to anyone. So if you just wanted to click the link I provided, you can go ahead and sign up that way. Sorry.
Oh, awesome. Awesome. Thank you.
Or if
And
you want, I can send you an email that has all of the information on there as far as the maximum contribution levels that you can do for each type of account, whether that's, you know, traditional Roth, SEP, simple.
don't hurt his webinar. Come
I'm
on.
sorry. Listen, man, I just try to give people the information, right?
That's right.
I feel you, man.
Do what you want to do with, you know, whatever your time you have. But, you know, I have a busy schedule. So if I can get all the fine points that I can get, then that's what I do.
All right. And quick thing also, I'm doing a self-directed IRA right now in the process of doing it. And you mentioned stocks, and I do stocks, options, some crypto also. And so what I'm gonna be doing is what I'm thinking of doing is perhaps I'm setting aside some of that for investing in some self-directed IRA funds for investing in the market. But from the advice I received from the manager, self-directed management company I'm using is if I use margin, even though it's a Roth IRA, that the marginable profit might be taxed despite being an IRA. How factual is that information?
You talking about inside of your self-directed IRA?
It's inside of my self-directed IRA, and say that I transferred some of that funds to TD Ameritrade, which is what I tend to use, and I use, and with that self-directed IRA, I'm able to use margins to do my trades. If I use margin, the profit that's attributable to the margin is taxable despite me using a Roth IRA. Is that?
Yeah,
I've never heard that before until that.
Yeah, I'm not sure. I'm not sure, but I do know that there are different rules when it comes to using margin. And for those of you who don't know what margin is basically borrowing other securities to do other things, and so then you make the difference. So you know, I'm not sure by being held in it, but I'm pretty sure that you probably have to pay some type of, you know, maybe not a tax, but some type of interest just for using the margin itself.
Yeah.
You know, I don't know that specifically.
Okay.
Corey,
Yeah.
Do you want to speak to that, Corey?
Honestly, I do not have much input to that effect either. Until Marcus just explained it, wasn't necessarily familiar with margins. I don't do any stock investing myself. So that question in itself was kind of over my head, to be honest. Again, honesty, I'm not going to try to fake the funk on that.
So buying on margin is, to keep it in layman's terms, you're using borrowed money. And so you are subject to UBIT taxes, just like you are with any borrowed money inside your IRA. And it's one of the things that most syndicators do not talk about. So if you're in a syndication, any money that you're earning profits from that is borrowed money, you're going to have to pay the UBIT tax. So if I'm a syndicator and I borrowed 80% of the money to buy this apartment complex, then you as an IRA investor are subject to the UBIT taxes based on the amount of money I borrowed. And margin is treated the same way.
Even with Roth IRA?
Yes.
That makes sense.
Okay.
So Jim, thanks for that. I'm familiar with most of what you just explained, actually. And just one thing I would piggyback, I think you just mentioned you are a syndicator. I just recently learned as well about syndicators setting up blocker corps for the retirement account investors specifically to be able to evade that UBIT tax. Are you familiar with that, or could you piggyback on that to any effect?
Yeah, that's something that is relatively new in our circle, and people are trying to put these structures in place to help avoid that. I have not looked deeply into it, so I wouldn't want to stick my foot in my mouth and make any any recommendations and or observations about it. But it is definitely something that you should look into and talk to your IRA advisors. Also, Corey, do you guys do solo 401ks in addition to IRAs? Do you do both?
We do. We hold traditional IRAs, Roth IRAs, SEP Simple, 401k plans for self-directed or solo accounts. And we also offer a do your own or do yourself 401k model as well. So basically, for the most part, any type of retirement account that you can hold at another custodian, you can hold self-directed through us.
Yeah. So Greg, if your account is self-directed, it's something you can look into is some of the newer strategies, or you could look into converting to a 401k if you're eligible, and you would avoid all of the UBIT taxes and the UBIT penalties, because they don't apply to the solo 401k.
Yeah, and that's something we do that on our side with solo 401ks, individual 401ks. We do all that. We just not held inside of a self-directed platform. So if you wanting outside of that, then we can have a conversation.
And Marcus, let me just ask you a follow-up question. Something you mentioned earlier in your presentation was kind of setting up a checkbook control LLC entity to then further invest into. Would that be something that if a self-directed client were to have a checkbook control, your firm could hold managerial responsibilities on that and then invest or diversify part of that for the client if they weren't, so inclined themselves?
Absolutely. Absolutely. In which, like I said, I have a few self-directed platforms that I talk to on a I'm not gonna say daily, but we talk.
Yeah.
And I help them out on that front. So yeah, absolutely.
Okay. Yeah, we'll talk after for sure.
Okay.
Marcus, you had mentioned earlier in your presentation about the insurance policies and stuff like that.
Mm-hmm.
Does your company provide the type of insurance policies where it grows value? Oh, I don't want to call it a whole life, and I may be wording it wrong.
So I know what you're trying to ask. Yes, the ones that the IUL that I refer to is a type of policy where it's not attached to the insurance company, is actually attached to the market. So they have different indexes that your money is invested in, whether that's the S&P, whether it's a Prism fund, et cetera. And so basically what you're doing is you're overfunding the insurance policy. The extra money is going into whatever that index is, and all that money grows tax-free. The beauty in it is that you have all upside, no downside. So if the markets ever take a correction, you don't lose money, you just don't make it. And now you're able to pull all that money out tax-free, and there's no limit on how much money you can put into it. So a lot of people use it similar to a Roth, except for now you get rid of, the limits that Roth has onto it. And also you get rid of the 59.5 because you're able to pull money out before 59.5.
So is there a limit? Like, do you have to wait over a certain period of time
before you can start
to pull the money out? Say if I had the policy
mm-hmm.
and I wanted to take out, say, $50,000 to invest into a commercial product,
mm-hmm.
and can I do that with your policy that you're talking about?
Absolutely, right? But you got to have the cash there, right? So it's not going to be something that you're borrowing against, right? So it's basically you're going to be building the cash up yourself, in conjunction with whatever the index is doing. So if you have $50,000 in cash built up inside of your policy, then you're absolutely able to take it out tax-free and to do whatever you want with it.
Okay, and I just pay the insurance policy back.
Well, you can, or you don't have to, right? Because then so if something were to happen to you, they would just deduct that away, and then whatever's left will go to the people who you care about. So it just depends, because you're always going to buy on these policies what we call an increase in death benefit. Mm-hmm. And so basically what that means is that you're going to be able to get whoever your beneficiary is going to get the death benefit as well as the cash value. And it's just not one or the other, because sometimes people buy what we call level, and then they only get the death benefit and not the cash value. And so all of the policies that I'm referring to, you get both.
Got you. Okay. All right. Thank you.
Now, Marcus, is that a
whole life or a term insurance?
So this is going to be I call it a permanent, because whole life is a policy in itself, right? So whole life would be a policy like what Northwestern Mutual would put out, where the policy pays you a dividend, right? The ones that I'm referring to are called universal. And so, yeah, they'll cover you for your entire life. But generally, I tell people that if you're buying an IUL, you're probably not buying this just for the insurance. You're really buying it for the tax benefits and the building the wealth aspect, the cash benefit for it. And so, and two, you want to keep the reality is that when you're buying one of these policies, you really want to keep the death benefit down, because now you're starting to, if you have one that's super high, now the cost of the insurance is higher. We want to really keep that low because we want more money going to the investment side versus it actually going towards paying for the insurance. And so generally, if I'm going to have someone who just needs insurance, I'm probably not going to talk to them about this. But if someone is wanting to do kind of a hybrid where they need insurance and they want to build a cash, then this is a viable option.
Are the premiums generally higher than a regular?
No, it's not higher. Definitely not
insurance?
higher, but it's also going to be dependent on, your health, right? So if your health is not as good, and I mean, not as good as being like the big major factors such as, cancer, heart attack, stroke, the big stuff. As long as you don't have any of that, then you can pretty much get a on par coverage amount. But the beauty is that the idea is that we're overfunding it. So generally, you probably don't even feel the cost as much. But what we want to make sure we're doing is hit what they call a target premium. And that's something that will run for you to figure out what's going to be make the most sense. But I have clients that are doing, a couple $1,000s a month into these things, and they're able to build up so much tax-free income for people.
Okay, very good. Thanks for your help there.
Yes, sir.
I have a question for you guys. Can you speak a little more on the universal life or a cash value life insurance policy as a gift, say for a grandchild?
Absolutely,
like
that's a beautiful thing. It's a new strategy that I've been implementing for the last 8 years. And basically what we've been doing is, instead of doing 529 plans or UTMAs or UGMAs, and for those who don't know what UTMA and UGMA, because I heard somebody saying you're the alphabet, police or whatever she said. An UTMA is a uniform transfer, and the other one is a gift act. And so generally that's what most advisors used to go to. But as far as specifically to your question, what you're able to do is you're able to get an insurance policy on your kid, right? And so what that's doing is insuring your assurability. So you're able to not have to, the kids never have to worry about getting coverage again, because as we get older, our health declines. But in the meantime, you're able to build that cash value as well. And if it's linked to an index, say the S&P, right? Most people understand that, most funds don't outperform the S&P. So instead of trying to outperform, why don't we just get into something that's going to do exactly what the S&P does? And so that money is going to track whatever the S&P does. And then you're able to take that money out tax-free. And so instead of doing a 529 plan that has to go specifically to college, now this money could be used to do whatever you want, right? So you could, go out and buy real estate. You can go out and, go be the next Steve Jobs or whatever their little heart desires. It doesn't have to be specifically for college. It could be used for any purpose that you want it to be.
So I could be the curator of the account.
So yes, you could be the owner. Yeah, you would be the owner. And then the kid would definitely be the beneficiary of the policy itself. Yeah.
So I've heard a lot about these, and I think it's a great idea. And my brother just had his first grandchild, and I suggested this to him, and he was, he's, not up on, wasn't aware of it. So I said, talk to your accountant, and his accountant came back and said that he should stay away from those. Is this something that an accountant wouldn't recommend, or?
That accountant probably doesn't understand what it is.
Yeah, that's what I'm thinking.
Or be versed enough to understand how it works. Generally, what happens though, you want to keep the insurance down as much as possible. So you're probably not going to do anything more than $100,000 policy. That's number one. And then number two, they like to see whoever the owner is have double the amount of coverage. So if I'm putting one on my kid, they want to at least see, if I have 100,000, I need to at least have $200,000 as well. And generally, you're only going to be contributing between 50 to $100 a month, right? It's not going to be anything super substantial. But again, one of the main principles that I talked about before is I believe that we should never put 100% of anything into one bucket. So, you can still do this, right? And along with a 529 or an UGMA or a custodial plan or a Cadova, whatever it is, right? You can have all those different types of plans as well, but this could be one of the plans that you have as well. And I like it just because it gives you two things. It gives you that insurability of the insurance coverage, and it also gives you the tax-free income.
Thank you.
And Marcus, James, let's say James were to do that for one of his grandkids, right?
Yep.
He can also borrow against that money too, right, James?
Absolutely. Yeah, he's the owner. He can do whatever he wants with it.
I can, in an attempt to grow it as much as possible.
Absolutely.
For my benefit, for my grandchild. Yes.
Now, anything about borrowing, you have to just understand that the interest rates on that stuff changes year to year. So, most of it's going to be under 4%. So it's not going to be anything crazy. But, just have to keep that in mind too. And it also depends on what carrier you go with, which, somebody like me who's an actual broker, we pretty much have everybody. So it's not one specific company that we're looking at, right? So it's not like I'm on here working for Northwestern Mutual telling you, hey, man, let's get this Northwestern Mutual policy, right? So we have a range of different companies.
Awesome. Great questions, guys. Does someone else have anything else to add or chime in?
I have one other question.
We're always trying to get money to get our commercial deals, Mark.
I see, man. I see. Listen, man.
We want money for them commercial deals.
That's why I brought him on.
I have one question or a statement, and I don't know if there's an answer to this, but why when you're in is there an answer to why when you're in a company sponsored 401k that your money is locked into that? You can't transfer
because all plans are governed by ERISA. And ERISA sets the guidelines and principles for that plan sponsor. And so everybody's plan sponsor is going to have different rules and they have to abide by them. So, whether that's your plan sponsor is Fidelity or, Mutual Omaha or, it's so many Principal, it's a whole Great Western. They all have different rules and stipulations. But that's why I generally tell people that if you leave your job, you're not there anymore, you shouldn't leave your money there either, because you can have more control when it's outside of your employer, right? Whether that's coming on my side, which I call I guess I'm the safe dinosaur way, or you can go, in this new self-directed idea where I can have all this precious metal and, real estate and all this, cool stuff inside of my IRA, right? So there's options now for people, right? And I'm not telling you one is better than the other. It just really depends on what your specific situation is. And I think they can go hand in hand, right? So again, it's like the old saying goes, never put all your eggs in one basket. I'm a firm believer of that. And I think that you can absolutely do both and be proficient in both areas.
Marcus, do you invest in any kind of real estate?
Yeah, I own my home. And I'm looking at another opportunity as well, is to kind of start getting some passive income from a rental property. So we're looking at that. But again, man, I'm a firm believer in laying down the foundation for all areas before I just start jumping into one thing and the other. And so my portfolio looks really good from all of the circle of wealth where I talked about. And so now that everything else is starting to align, now we'll start exploring more opportunities. But the reason why I'm such a stickler for that is because once one thing goes down, right, what happens if we go back to 08 or 09? What are you guys going to be talking about then? Right? If all of our cash money is tied up in the real estate and we go back to 08 or 09, half the people on this call are wiped out. So, understanding that we need to have money in multiple buckets outside of just one area, I think that it sets yourself up to be able to withstand when we have market corrections, which I do believe is on the horizon, just because when I'm looking at the way things are going, it's starting to remind me too much of what it looked like in 08, 09. And you can debate me all you want to on that. I probably won't listen, but I'm just telling you, that's what it looks like to me. And I'm just joking.
No, that's pretty good. And 08, 09, maybe someone can answer this. How did commercial multifamily fare out in 08, 09 during the crisis?
From what I've read and studied, I think commercial multifamily actually fared pretty well. The residential side actually took a heavy hit.
Yeah, residential side took a big bang, right? Lost a lot of value. I know, because I was caught up in there.
I mean, I don't know specific,
but commercial
so-
multifamily, they sort of failed very well. So if you heard what he said, if you're in that residential, you get another big hit, you're gonna lose your money.
Yeah.
I mean, listen,
Now-
man, when the banks start losing money, people start losing money across the board, right? I don't care where the money is held, right? I mean, of course, some people made money in 08 or 09. Of course, a lot of millionaires were made. But my whole point of saying that was just to make sure that when we do put money, because no money is play money to me. So when I have money invested, I want to make sure that I have multiple ways of getting it and multiple ways that it's diversified. And that's my only point on that.
Marcus, how do you feel about the REITs? You know, not
so
physically owning the real estate, but getting into those stock REITs.
I love the REIT option a lot more. Why? Because they have to, give out 90% of the dividends, right? So it's a less riskier way for me to not have to have the asset itself, right? Because if I need liquidity, I'm able to sell that stock, right? Versus if I have to sell a house. I mean, right now it's a seller's market, so it may not be the best example, but again, I don't believe that this is going to continue to be the trend. And so if I'm invested in REITs, it just kind of gives me a level of comfort, right? And again, I come from an old school way. I started my career at Edward Jones, and I don't know if you guys know about Edward Jones, but it's kind of that, grassroots type firm. So I guess I'm a dinosaur in that sense, but that's just kind of the way I learned how money works. And that's just kind of the strategy that I've been sticking to, and it's been working for me thus far. So I'm not going to change it.
Okay, very good.
That's right.
All right, Marcus. I want to do some quick breakout rooms. So if anybody wanted to get in touch with you, you're right now you're on Instagram Live and Facebook Live. So if anyone wanted to get in touch with you, how can they reach you?
Yes, sir. Again, appreciate you for having me. I appreciate all the questions. And you can reach me at my email at marcus@johnsoncap.com, or you can email my team at info@johnsoncap.com. And you can find me on social media at Johnson Capital Planning, or if you can find me personally at Marcus DIONTEJ.
Marcus,
Awesome.
did you put all that in the chat?
I will.
Yeah, please put that in the chat, please.
In the chat.
I will put that in the chat right now.
And Corey, I do want to thank you for dropping in as well. Again, I'm very familiar with Avanta. As I mentioned in the chat, I had a call with Clay a while back, and a wealth of information. So I definitely will speak with you in regards to jumping in and, chiming in on your expertise as well. So if people wanted to find you, how can they reach out to you as well to get questions answered?
Yeah, sure. Thanks, Mark. And again, I found you on Meetup, so it was a pleasure to join the group and glad I was able to be helpful. If anyone wants to reach me, my email address is going to be my first initial and then my last name at advantaira.com. That's CDAHARSH. It's in the chat group, chat box a few times over, I think once or twice. And then my phone number as well is 727-223-3046.
Awesome. So social media world, it's been real. We're about to have a breakout room. So if you guys want to join in, next time, go to meetup.com, look for financial freedom through apartment investing. Feel free to join in. We'll have a ton of content and great guests. Until next time, peace.